Financial relationships, money in partnerships and families. Money is one of the few things that touches every relationship in life, whether it's between spouses, parents, and children, siblings, or even close friends. Financial decisions often shape trust, security, and long term happiness. Surprisingly, it's rarely the amount of money that creates conflict. The more often misunderstandings, different financial habits, hidden expectations, and lack of communication become the real challenges. Every person develops unique beliefs about money based on childhood experiences, culture, education, and personal successes or failures. When two or more people bring different money mindset into one relationship, disagreements naturally arise unless they communicate openly. Financial conversations may feel uncomfortable at first, but avoiding them usually creates bigger problems over time. Healthy financial relationships are built on honesty, respect, shared goals, and teamwork rather than perfect financial situations. In this video, we will explore 10 practical principles that can help partners and families discuss money confidently, reduce financial stress, and build stronger relationships together. Whether you are just starting a relationship, managing a growing family, or supporting aging parents, these lessons can help create financial harmony for years to come. Point number one, we are going to discuss understand that everyone has different money story. Every person develops a unique relationship with money long before earning their first paycheck. Childhood experiences, family values, economic conditions, education, and personal successes all influence how someone saves, spends, invests, or borrows money. One partner may see money as security because they grow up during financial hardship. Another may view money as a tool for enjoying life because their family believed experiences matter more than possessions. Neither perspective is automatically right or wrong. Problems begin when people assume their own financial habits are the only correct approach. Instead of criticizing differences, couples and families should explore each other's financial backgrounds with curiosity. Asking questions like, what did your parents teach you about money? Or what financial experiences shaped you? Creates understanding instead of judgment. Recognizing these money stories helps explain behaviors that otherwise seem confusing. When people appreciate each other's financial history, they become better teammates in building a shared financial future rather than opponents trying to prove who is right. Let's say example for this point. Sarah saves every extra dollar because her parents struggled financially, while David she enjoys spending on travel because his family valued experiences. Understanding each other's childhood influences helps them create a balanced financial plan. Next, to point number two, make money conversations regular, not emotional. Many families only discuss money when something goes wrong, a large bill, unexpected debt, or financial emergency. Unfortunately, stressful moments are the worst time to make important decisions. Instead, successful families schedule regular financial conversation before problems arise. These discussions don't need to be long or formal. A monthly or weekly money meeting creates a safe environment or review income, expenses, savings, upcoming goals, and concerns. Regular conversations reduce surprises and encourage transparency. During these meetings, everyone should listen respectfully without blaming or interrupting. The goal is not to criticize spending but to work together toward shared objectives. Consistent communication builds trust because financial decisions become collaborative rather than secretive. Over time, money discussions become as normal as planning vacations or family events. Healthy communication transforms finances from a source of anxiety into a shared responsibility where everyone feels heard and respected. Let's say example, every Sunday evening, Lisa and Mark spend 20 minutes reviewing their budget, discussing upcoming expenses and celebrating savings progress instead of waiting until financial problems appear. Next, point number three, set shared financial goals together. Relationships become stronger when everyone works toward common financial goals instead of individual priorities. Shared goals provide motivation, direction, and purpose for every day financial decisions. These goals may include buying a home, building an emergency fund, paying off debt, saving for children's education, planning retirement, or taking a dream vacation. When people understand the why behind financial choices, they become more willing to make temporary sacrifices. Goals should be realistic, measurable, and regularly reviewed because life circumstances change over time. Writing goals down and tracking progress creates accountability while celebrating milestones maintains enthusiasm. Even if family members have different personal interests, agreeing on a few major financial objectives strengthens teamwork. Financial planning becomes less about restriction and more about creating opportunities that everyone values. Shared goals remind families that every small financial decision contributes to a much larger future. Let's say example for this point. Instead of arguing over unnecessary purchases, a couple agrees to save $500 each month toward a down payment for their first home, making daily spending decisions easier. Next, point number 4, create a budget that everyone understands. A budget is not a tool for limiting freedom, it's a roadmap that helps families use money intentionally. Without a budget, people often wonder where their money disappeared. A simple family budget identifies income, fixed expenses, savings, investments, debt payments, and discretionary spending. Everyone involved should understand how the budget works so financial expectations remain clear. Budgets should also allow flexibility because unexpected expenses are part of life. Instead of viewing budgeting as punishment, families should see it as a plan that supports their goals and reduces financial stress. Reviewing the budget regularly helps adjust spending as income or priorities change. Transparency prevents misunderstandings because everyone knows the financial situation. A well designed budget creates confidence, encourages responsible spending, and supports long term financial stability without eliminating enjoyment. Example for this point, a family allocates monthly income toward housing, groceries, savings, entertainment, and emergency funds, ensuring every dollar has a purpose before it's spent. Next, to point number 5, be honest about debt and financial challenge. Financial honesty is one of the strongest foundations of trust. Hidden debts, secret credit cards, undisclosed loans, or concealed spending can damage relationships more than debt itself. Financial transparency allows families to solve problems together instead of facing unexpected surprises later. Everyone experiences financial setbacks at the same point, including job loss, medical expenses, or unexpected emergencies. Honest communication encourages teamwork rather than blame. When discussing debt, focus on solutions instead of assigning fault. Create a repayment strategy, prioritize high interest obligations, and celebrate progress together. Openness also reduces emotional stress because financial burdens become shared responsibilities. Trust grows when people know they can discuss difficult financial situations without a fear of judgment. Honest conversations today prevent larger relationship conflicts together. Let's say example, instead of hiding credit card debt, Alex tells his spouse about the situation, and together they develop a realistic repayment plan that strengthens their trust. Next, to point number 6, respect different spending priorities. Not everyone values the same purchases. One person may prioritize education while another values travel, hobbies, technology, or family experiences. Financial conflict often begins when people criticize each other's spending preferences. Instead of understanding them, healthy relationships recognize that responsible discretionary spending can improve happiness when balanced within the overall financial plan. Instead of controlling each other's purchases, families can establish personal spending allowances alongside shared financial responsibilities. This approach creates both accountability and independence. Respecting individual preferences demonstrates trust while reducing unnecessary arguments over small expenses. Financial harmony doesn't require identical priorities, it requires mutual respect and thoughtful compromise. Appreciating different perspectives allows everyone to feel valued while supporting collective financial success. Let's say example for this point. Emma enjoys buying books while James prefers spending on fitness activities. They agree on personal monthly spending limits while continuing to save toward shared goals. Next, point number 7, teach children healthy money habits early. Financial education begins at home long before children earn their first income. Parents who openly discuss saving, budgeting, giving, and responsible spending help children develop lifelong financial confidence. Age appropriate conversations about money reduce fear and encourage curiosity. Allowing children to earn allowances, save for desired purchases, compare prices, and understand delayed gratification teaches valuable financial skills through experiences. Children also learn by observing adult behavior. Parents who budget responsibly, avoid unnecessary debt, and discuss financial decisions respectfully provide powerful real life examples. Early financial education prepares future adults to manage money wisely, make informed decisions, and avoid common financial mistakes. Teaching money management is not about raising wealthy children, it's about raising financial responsible adults. Example for this point: parents encourage their daughter to save part of her birthday money before purchasing a bicycle, helping her understand patience and financial planning. Next to point number 8: prepare together for financial emergencies. Unexpected events such as medical expenses, job loss, home repairs, or economic downturns can affect any family. Preparing in advance reduces panic when emergencies occur. Families should discuss potential risk, build emergency savings, review insurance coverage, and establish backup financial plans. Preparation creates confidence because everyone understands what steps to take during difficult situations. Emergency planning also strengthens emotional resilience since financial uncertainty becomes less overwhelming. Regularly reviewing emergency plans ensures they remain relevant as family circumstances change. Prepared families recover faster because they make decisions calmly rather than emotionally. Financial resilience is not about predicting every challenge, it's about being ready to respond together when life becomes unpredictable. Let's say example, a couple gradually builds 6 months of living expenses in an emergency fund, allowing them to manage unexpected unemployment without immediate financial planning. Next point number 9, support family without sacrificing financial stability. Helping family members is an important value across many cultures, but generosity should be balanced with financial responsibility. Providing financial support without clear boundaries can create long-term dependence or strain your own financial future. Before offering assistance, honestly evaluate your financial capacity and discuss expectations openly. Sometimes emotional support, financial advice, or helping someone develop skills may be more valuable than providing money. Families should avoid making financial promises they cannot sustain. Healthy boundaries protect both relationships and financial security. Supporting loved ones becomes more meaningful when it strengthens independence rather than creating ongoing dependence. Responsible generosity reflects both compassion and wisdom. Example for this: instead of repeatedly lending money, a brother helps his sibling create a budget, improve job search skills, and develop long term financial independence. Next, to point number 10, build a financial partnership based on trust. The strongest financial relationships are built on trust, communication, respect, and shared responsibility rather than income level. Successful families celebrate financial victories together, learn from mistakes without a blame, and continuously adapt as life changes. Trust grows through honesty, consistency, and mutual support during both prosperous and challenging times. Financial success is not measured only by wealth but also by the confidence that everyone works together toward common goal. Strong partnerships encourage open discussions, fair decision making, continuous learning, and long term planning. When trust becomes the foundation, financial disagreements become opportunities for growth instead of sources of conflict. Ultimately, money becomes a tool for building a secure, meaningful, and fulfilling life together. Example for this point: after years of open communication, a couple confidently plans retirement together because every financial decision has been based on honesty, cooperation, and shared vision. Finally, financial relationships are not built by having unlimited money. They are built through honest conversations, mutual respect, thoughtful planning, and shared commitment. Every family and partnership will experience financial challenges, but those who communicate openly are better equipped to overcome them together. Remember, money should strengthen relationships, not divide them. Start with one simple financial conversation this week. Listen with understanding and work towards shared goals one step at a time. Small conversations today can prevent major conflicts tomorrow and create lifetime of financial confidence, trust, and lasting family harmony. If you found this video valuable, don't forget to like, share, and subscribe for more practical financial education that helps you make smarter money decisions and build a strong financial future. Thank you.